I recently caught up with Nick Pappas, head of credit for hedge fund firm CQS, which manages about $20 billion. His perspective on distressed investing is especially interesting at a time of fairly little widespread distress. How does one go about finding substantial returns in debt at a time of broad central bank stimulus? Nick talked about where he finds buying opportunities and started with non-performing loans in Europe.
Less so than in 2011, but the difference now is if we go back 10 years, just post the global financial crisis, the markets were much smaller. So combined global high yield and loans has more than doubled in size since the financial crisis. So right now, in a low default environment, 100 billion, a low default environment being, call it 5% if we include debt exchanges and defaults, that's creating 100 billion of new distressed product every year. Just in this environment, and it goes up exponentially if we had a downturn in the economy.
So how close do you think we are, considering the fact that you do due diligence on company balance sheets regularly? How close are we to some sort of downturn like that?
A downturn? Look, I think near term, the market's okay. Last time we spoke, the thesis I have is exactly the same as it was in November. I think central banks are very accommodative. So fiscal policy is very easy. I think growth is okay. I think if anything, growth is on the mend in both Europe and China. I think it's troughed and improving, and markets tend to not trade off. They don't go down when growth is low but slowly improving and fiscal conditions are very easy. Markets tend to hold, and we tend to have a risk-on environment, which is good for credit. So I don't see anything on the near-term horizon, but I think longer term, if we just look at credit, even if we don't have a meaningful recession or any sort of downturn in the economy, because of what I'd mentioned earlier, because of the credit market doubling in size, there are just so many more opportunities. They're so sensitive to a downturn. The other thing that's happened since the financial crisis, 2009, average leverage on a deal was 3.99 times. It's now 5.2 times. Covenants at the time, 14% of deals were covenant light. Now it's 83%. EBITDA adjustments are at all-time record highs. So that in itself can create a large distressed credit opportunity.
Which industries do you think are most vulnerable to some sort of pocket of distress?
Look, I think we've seen it in oil and gas, we've seen it in retail, but that's more old economy. Or I'd call it mature to old economy, but I think we're seeing it across everything. I mean, something like a Survitech is an operational error.
Just the glut of money coming into these types of strategies.
Yes.
How do you source these deals at competitive valuations or things that look attractive given how much money is coming into the space?
I think there's been a paradigm shift where the selling that we're seeing is so extreme versus what we had seen in prior regimes. So, for example, in the global financial crisis, it was more of a macro sell-off. Now we're seeing extreme selling, and I think it's because passive management doesn't have the resources or expertise to either work out deals or follow their money. Because it's low fee, if you think about it, low fee, they don't have distressed workout teams to work out the loans and don't have the capacity to follow their money. And what we're seeing now is if a company has a liquidity issue, a disproportionate amount of the economics is attached to that new money component, therefore diluting the old money, the old debt. Therefore, we're seeing much lower recoveries because of that. So I think following your money is very important in this market, and that's having and that's creating the selling. So if passive management hears the word restructuring, default, liquidity event, covenant breach, the sell button is just getting hit nonstop, and that's creating the opportunity for us. That's creating lots of dispersion.